coming into today. So, what everybody's starting to say right now is that the market has gone up and that this is really over, and that at this point it is just going to rally higher. It's going to be a V shaped recovery, and we are done with this. And I think that is very unlikely unless I get more follow through. Even then, I think that the market is headed lower. And here's why. From a fundamental basis, two things need to happen, or well, one of these two need to happen. If both of them happen, then that's great for the market, but one of these two need to happen. Number one, valuations need to go down. Or number two, and the only way valuations can go down is if the market goes down. Or number two, we need to see the Fed start buying stocks on their balance sheet. So one of those two things needs to happen, and so I don't think any of them has yet happened. I don't think we're at low valuations yet. I still think things are pretty expensive right now. And number two, I said that the Fed would need to start buying stocks on their balance sheet, and that's not going to happen yet. I think it will eventually happen, though. So right here, I circled some things. Looking here, right here, everybody thought that that was it. And again, we're running across one of those situations again, though right here is a bit bigger, and for a couple of reasons. First, we had a professor come out and say that the coronavirus will not be as bad as it seems. But this professor, who knows? First off, it's just one professor. Secondly, this professor was made famous for first coming out and talking about the coronavirus, and now he's saying it might not be as bad as it seems. But then he included some other information which actually made it seem worse, and so I wasn't exactly sure why the market reacted positively to that. It might have just been the news headline. And so there was that right there. Second thing, which I think is even larger, was that, of course, he had an oversold bounce, but you also had a portfolio restructuring. Most people, most mutual funds, or just anybody who handles money in the retail space, so financial advisors who are helping people, private wealth managers, what they always say is take the amount of money you have and put it in bonds relative to your age and stocks and everything else. So if you're 40, you might have 40% bonds, 60% stocks. And so you start to run across a situation in which stocks have gone down so much that people have to restructure their portfolios every quarter, and so it pushes the market up even more. But I think this is just temporary. I think that we will likely top out right here, and so top out right here at this fib level, if not right here or right here. But I definitely think that this is not the top. And the reason I'm making this video is because everybody always thinks it's the top. People thought this was the top, and that's why I came out with the video a few weeks back, I think. It's probably maybe 2 weeks back-ish, and I basically said, can the market go lower? And I said, definitely, and I even put a bear on the thumbnail for that video. And yes, the market has gone lower. And so with that right there, the market has gone lower, and I think that this, at the end of the day, is just a lower high, and from here, it is headed down. And the reason I'm making this video is because many people are going to lose their ammo. What I mean by that is that the market goes down 5%, they buy a little bit. Market goes down 5%, they buy a little bit more. Market goes down 5%, they buy a little bit more. Market goes down 5%, they buy a little bit more. By the time it goes down 20%, they have lost all their ammo. They have dollar cost averaging down, but they have lost everything. They have zero cash left. They are all in the market, and so they lose all their ammo before the market even bottoms. And that is a problem right here that people are going to start to face, and many people have already faced that. I'm seeing videos, people saying, "Oh, I'm buying Apple." Again, if you want to buy Apple, look at the video that we made, because if you would have bought Apple, you would have lost money. But if you listen to the video that we made, you don't lose money on Apple until it goes below 170, and I think that's turning out fairly well. And a lot of people watched that video and took the advice right there that was given of not buying Apple and doing what we did instead, which was an options trade. So do that. If you really want to bet bullish on the market. Another thing you can do is that instead of going out and buying 100 shares of a stock, instead what you can do is, let's say a stock is at $100, you want to buy 100 shares, that's $10,000. What you can do instead is just buy an at-the-money call for $100 and take the other $9,900, put it in cash. Worst case scenario, it goes against you and you lose $100, but if you would have bought the 100 shares, you might have lost more than that. You might have gone and you might have lost out of that $10,000 you might have lost 20% of that, and that's $2,000. But right there, you only would have lost the 1%, the $100, and the other 9,900 was still in cash. And so if it goes higher, then instead, you still make money. And so you're risking a very small amount. I think that's a better strategy if you really want to bet bullish on the market. I would not do it right here. I think from the Elliott wave analysis, from Fibonacci, from the way we're seeing the fundamentals working out, the market has not bottomed out yet. So I still think the market is headed lower. And again, the reason I'm making this is because so many people always want to buy the dip. And I don't think the mantra of buying the dip will work anymore in this environment. And people will run out of ammo before the market even bottoms or before it's anywhere close to bottoming. Some people are already out of ammo. And we're out of ammo way back when it was at 2,800, like right here. Many people were already out of ammo at that point. And so you don't want to run across that situation. And I see many people, I saw a video from Keenan Grace where he said he's going to buy Disney stock, and he said he bought some more Apple, I think, and some more index funds. But I would hold off on that if I were a long-term investor. But if I was really sitting on my hands and I wanted to do something, what I would just go ahead and do is a options trade right there. Structure similar to how we structured our call spread risk reversal on Apple, or structure it in a way that that you would risk a small amount by doing probably a protective put or a cash secured call. And then looking at TLT, I think that this is the end of the risk parity trade. What do I mean by that? The risk parity trade is where everybody just buys stocks and they buy bonds. So they say if the stocks go up, the bonds go down. The bonds go up, the stocks go down. So who cares? My risk is controlled. Stocks and bonds are only inversely correlated for the last 30 years. I don't think they're going to stay inversely correlated anymore. And so I think that we're going to have a situation where right here, and I can actually show you right here on the chart, this right here was early, I would say, let's see if we can move this out of the way. This was very early into March, and so the market was still falling at this time. So early into March, we look over here, the market was still falling at this time. It fell quite a lot, and it was all the way up here. Yet TLT topped out and it came down. And so long-term treasuries are starting to come down because people are starting to learn that the risk parity trade doesn't work, and they're trying to start to exit that trade because stocks and bonds are not supposed to be negatively correlated. It just so happens that they did that over the last 30 years. And I think that this top right here, over at 180, is the very top. I think that that is the 50-year top on bonds. And again, I'm saying this again and again, that many decades, nothing happens. In many weeks, decades happen. So just right there, over the last couple of weeks, we've had decades of things happen. We have seen generational moves. And I think that this was the very top right here of the 50-year bull bond market that we have seen. And so it's sold off from there. Another thing that's starting to happen is that because yields are now so low, people are starting to realize these risk parity, even if you're doing risk parity, which is not a good idea because it's not going to work out anymore. But people are starting to realize that, hey, inflation is getting higher, and the long-term treasuries are not pricing this in. So what do I do at that point? So this is what we call premium term structure. People are starting to, instead of just buying a 30-year bond, and that's what TLT does, is anything 20 years and longer, instead of just buying a 30-year bond, they might buy a 2-year bond, and then after 2 years, roll it over, and then roll it over, and then roll it over, do that again and again, 15 times for 30 years. And that's actually more profitable. And that's why we have seen the sell-off, and we have seen the curve between the 10 and 30-year. Everything has steepened. And so before we were talking about inverted yield curves. Now, on the long end of the yield curve, 10 to 30-year, we're actually seeing the opposite. It's actually getting steeper and steeper and steeper, because everybody's selling off on the long end because they are just saying, I can buy a short-term treasury, just consistently roll it over again and again and again for the next 30 years rather than buying a 30-year treasury, which has so much risk and so little reward, actually a negative reward with negative yield. So I might as well just buy a short-term treasury and roll it over. And that right there is a premium term structure to be looking at. And so ultimately, I think that TLT, we could possibly see it get down to 120, and when it gets down to 120, maybe the Fed will come out and start doing QE on it and buying those up. And I think that the S&P 500, we could see the S&P 500 definitely get down. And so this is the hourly. Let's go out. If we can go out on the daily, I think we could see it get to 1800, but definitely I think it's going to break 2000. And right now it does seem to be the top right now in the market, temporary top right now in the market, but it could go higher or higher from there. But I think that's unlikely. I think that this fib level right here is the top in the market. So if you have any questions, go ahead and ask. This fundamental analysis usually takes a lot longer, but I try to sum it up pretty quickly right here. But if you want to go more in depth, I usually do that inside the comments section. So ask me any questions you may have in the comments section. If you have any comments, that's what the comments section is for. Any constructive criticism, go ahead and put it inside the comments section. Other than that, happy trading, happy investing, and stay safe.